In this short video, we're going to look at IAS 17 on leases. So at the end of this, we should be able to state what a lease is, explain the difference between a finance lease and an operating lease. We'll provide examples of circumstances that indicate a finance lease exists, and then describe the different accounting treatments for finance leases and operating leases. So we'll start off with the question is, what is a lease? Well, it's an agreement whereby a lessor gives the right to use an asset for a period of time to a lessee in return for a payment or a series of payments. So an example would be if X Limited entered into an agreement to lease a lorry for 4 years from Y Limited. Now in this circumstances, X Limited would be described as the lessee and Y the lessor. And as part of that agreement, Y Limited will provide that lorry to X Limited for a period of 4 years. And X Limited will agree to pay an amount to Y Limited for that use each month. Now, when we look at leases, although on the lease agreement itself, the document, it will simply say that this is a lease agreement, accountants split leases into two different types. There are finance leases. Now, these are leases where all the risks and rewards of ownership are substantially transferred to the lessee. And we also have what are called operating leases. And the definition of this is very simple. It's simply any lease that is not a finance lease. So we'll start off by talking about finance leases. Now, this is what happens where there is just little difference in substance between leasing the asset and actually buying it using a loan. Now, with these two different options, leasing the asset under a finance lease and buying it using a loan, the legal ownership of the asset will differ. Under a lease agreement, the ownership of the asset will remain with the lessor. And if you buy it using a loan, then the company itself will own that asset. But everything else will be the same. So let's have a look at an illustration. So a company acquires two identical machines. One is bought outright for £4,000 using a bank loan, which is repaid at £1,000 per year for 5 years. So there, the company would be charged £1,000 in interest over that 5-year period. And another is leased at £1,000 per year for 5 years, and we believe that both machines will be worn out after 5 years of use and won't have any value remaining in them. Well, let's face it, the two methods are identical in cost. So both will cost £5,000 to the company over the 5 years, and it's the same in benefit because under both purchases, or both under the purchase and under the lease agreement, the company will be able to use that machine for its useful life of 5 years. So the accounting treatment of both should be similar, even though that leased machine is never going to be owned by the company. This idea of treating similar transactions in a similar way is known as substance over form. But of course, how do we know when a finance lease exists? Well, it's going to be when a lease transfers ownership to the lessee at the end of the lease for free or at less than its expected fair value. When the lease term covers most of the asset's economic life, when the the present value of the lease payments cover most of the fair value of the asset, or where the asset is very specialised and couldn't easily be used by somebody else. Now, I'll just make a note about land, because with land, the lease of land is normally an operating lease. I suppose the most common exception to this is where uh, the title to the land passes to the lessee at the end of the lease. Under those circumstances, we would treat it as a finance lease, but that situation where the ownership passes to the lessee at the end of the lease is pretty rare, so normally the lease of land is going to be an operating lease. That doesn't hold the case in respect of buildings, however. So the lease of buildings can either be an operating lease or a finance lease. In those circumstances, we would look at the characteristics of the lease and see whether or not it substantially transfers the risk and reward of ownership to the lessee. Okay, so how do we treat a finance lease at the start of the lease agreement? Well, first of all, we record the asset as a non-current asset, so it would be recorded as property, plant or equipment, and we'd record its cost as its fair value. Now, this is normally the market value or the amount that you could buy it for. And we will also record the value of that lease, the fair value, as a liability in the accounts. Now, once we've recorded the asset as, leased asset as a non-current asset in our statement of financial position, we will then start depreciating it as we would any other piece of property, plant and equipment. But over what term should we depreciate it? Well, we do it over the asset's useful life, where the lessee expects to become the asset's owner at the end of the lease term. But that's not always the case, and where the lessee doesn't expect to become the asset's owner at the end of the lease term, it'll be depreciated over the shorter of the asset's useful life and the lease term. But let's face it, it would be pretty unusual to have a lease where the lease term is actually longer than the asset's useful life. Right, so what then do we do when we start paying lease payments? Well, the lease payments themselves are going to be split between a capital component, being an amount that will repay the liability, and a part of it will be in respect of interest. So the capital element will be set against the liability, and the interest element will be charged to the income statement or the statement of profit and loss, and it'll be recorded in the finance costs section of that statement of profit and loss. Now, at the end of the lease term, the liability should have been repaid in full, so we will calculate our split of capital and interest to ensure that that happens. So finally, let's just have a look at how we deal with operating leases. And here the treatment is quite straightforward. We simply charge the lease payments to our statement of profit and loss or income statement on a straight line basis. No asset is going to be recorded in the statement of financial position, nor do we record a liability. So let's have a look at an example. X Limited enters an operating lease to rent land for 3 years for £5,000 a year. So each period, X Limited will record an expense for £5,000 in its statement of profit and loss. Just to make you aware, there can be situations where lease agreements contain a lease holiday at the start of the lease. This can happen particularly with commercial property, where the person leasing the property is wanting to encourage someone to come in and start using that property. Where this happens, let's give the example of a business that leases a property over a 5-year period, but in the first year there will be no lease payment to be made. Well, in that situation, what we'll do is we'll calculate the total amount of lease payments paid over the 5 years. So that'd be nothing in the first year and then a regular amount in the next 4 years, and then we will spread that cost over the whole 5-year period. So that is what we mean by charging to the income statement on a straight line basis. Finally, I will just mention that this standard is going to be replaced by IFRS 16 in the very near future. And the new standard on leases makes some significant changes to the way that leases should be dealt with in a set of accounts.